Everyone for staying in and joining this panel. So broadly, we're here to discuss, what's going on with the VC industry in Southeast Asia. So, by this I mean, the challenges that the ecosystem is facing in terms of the liquidity crunch and the fundraising challenges. And we're going to look at how the asset allocators are maybe changing their strategies, whether moving towards private credit or more active in secondaries and other strategies. Basically, to be honest, like a lot of what we do is has a strong Southeast Asia bias. So our view is kind of influenced by that. In the last year or so, we have seen a number of VC companies in Southeast Asia changing their tact, like not completely, but quite dramatically. They did rebranding and pivot towards sort of like more PE like playbook, if you will. So doing multi-asset investment and more open to other products essentially. So we are here to discuss that, and I think we're joined by very distinguished panelists right here. They can speak from different perspectives because they represent different strategies. And I'm gonna let each one of you to introduce yourself and tell a little bit about your latest project or something. Thanks. Go ahead. We can start with you, PS. Yeah.
Hi, my name is Piyush. I'm the founder and managing partner at Kendro Capital. We are a growth secondary firm based in Singapore. Our primary geography is India and Southeast Asia. Our strategy is very simple, is that the exit horizon of any venture capital investor is not perfectly aligned with the exit horizon for a company. So how do you cater for the mismatch between those two structural factors? And we've created a fund that's able to underwrite companies directly. So we are direct investors on the cap table. So we are in the secondaries world. There's LP secondaries, GP led, and directs. So we are more direct. We do diligence on the underlying asset. We are a new fund. I spent 7 years in Sequoia, India before starting it. And I think one of my biggest realizations was that the venture industry is great at thinking about the trends and where the market may be going, backing the right founders to build those. But once the companies get large and they have to think about exits, they need some specialized help. And that's where funds like us come into play.
Okay. Go ahead, Conrad.
All right, thank you. My name is Conrad Zhang. I'm a founder and chairman of a Strategic Yield Holdings Limited. We're Asia-based private investment holding company. We mainly invest in growth and venture stage companies in Asia and in Series A to Series D in general. The sectors that we like to invest are climate, healthcare, education, IoT, fintech. And we spent a lot of time investing in the cross-border investments. So we're headquartered here in Hong Kong. So we will invest in Hong Kong, Greater Bay Area companies, help them expand into Southeast Asia, into the Middle East, along the Belt and Road. And so hope to communicate with you guys more. Thank you.
Hi, everyone. My name is Ming from Greater Asia. We were known as GGV Capital. And 26 years of history investing across venture growth and now public as well as private credit. I lead the private credit strategy, joined Greater Asia last year. I think some of you may have seen, we have announced, first close last year, 350 million, led by a few large sovereign wealth funds across the region. So I think in terms of my background, I've spent over 20 years investing, mostly in credit. So now very interesting to sit on this panel to talk about how we integrate venture capital, private equity, and private credit into the same platform.
Go ahead, Jerry.
So good afternoon, everyone. I think I represent the voice of pure play venture capital. My team and I, we've been venture capitalists for the last 20 years. I'm partnered with INS Capital. In a nutshell, we invest in early to expansion stage businesses into multi-trillion-dollar sectors, AI-enabled and biotech. We're big believers of Chinese heritage founders building global businesses and have a very strong track record of that. And I think all of you might have heard or at least used some of our previous investments, anything from Trip.com to Bilibili to TikTok, Xiaomi. And with thanks to Deal Street Asia, if you look at page 11 of the Q1 report, the very first deal in the mega deals, Q1 2026, that's one of our high conviction companies, Arendelle Labs. So yeah, that's In's Capital, dedicated VC for the last 20 years.
Great, great. Okay, thanks so much for that, Jerry. So let me begin with you. Of course, all of you guys represent different markets, and different markets mean different experience as well, right? Joji earlier today showed quote the Bain report how in terms of private equity investment has gone down in the last 2 3 years. But obviously, if you look at China data, it's different. We have seen recovery in India, for instance. I mean, things are going really well there, whereas Southeast Asia is obviously in a totally different situation where deal count and volume is going down. So with this background, in terms of the narrowing of equity model is something that at least we see in Southeast Asia, but what do you see in China? I mean, is there what kind of shift or pivot that you're witnessing in China?
Yeah, and thanks for that. I mean, I think, we've been in the industry for a long time. And before I joined the VCU, I used to be an LP investing across Asia Pacific. I think the shift is actually less about, whether venture still works or whether private equity still works. It's actually a shift in understanding what risks you're taking and also in the exit timeframe. It's a shift in understanding the realism of exits. And I think that's pushing GPs and LPs alike in our strategy and in our underwriting really to have more cycle awareness, to have more entry discipline, and to really kind of factor in the exits kind of from the get-go. And that will apply across to what sectors you invest in, how they're structured, how you're thinking about the exits. And for us, after 20 years, right, I mean, we also have a lot of lessons learned from ourselves, but we really think about exits at the start of the investment. And I think that is actually a bigger shift, is to understand how this model works in times where liquidity is not always available. But I do think that the innovation itself, venture capital itself as an asset class, and the reason why we have innovation and technology developments, that hasn't changed, and that will stay.
And that is reflected in terms of deal trends that you're seeing as well, right? I mean, in China, it's doing definitely better than other markets, I reckon.
So in terms of the deal,
In terms of the deal trends, deal volume, and
well, definitely. I mean, there has to be cycles, of course, but if you look around the world, kind of where technology is going and the talent in China, the grit of the entrepreneurs, somehow we make things work, the ingenuity, and then, of course, you have the whole supply chain. Technology is going to be a big thing for China, right, for sure. And we do see, I think, a reinvigoration of, deals being done. Of course, that's also with thanks to the Hong Kong IPO markets. That helps a lot, as well as a lot of the exits coming through. But you do see that innovation coming through.
Ming, can you share what you're seeing in Southeast Asia? Is this sort of like new strategy something that simply a cyclical response or something more permanent?
Yeah, sure. I think from investor perspective, doesn't matter which asset class, what we are seeing is Asia's growth. You cannot be supported by just one type of instrument, right? The great companies that was funded by VC now growing bigger. Different type of instrument, different type of investments, different type of helps that are still required to be able to help them, grow faster. That's where we started to think about how do we support good companies. We want to be with the good companies, good founders from day one when they're early. Also, at the same time as they grow, as they approach IPO or the next phase, we should have the right capital and right capability to be able to continue to make good investments. So I think from the demand side, the companies is driving this thinking for Greater Asia to look at how do we be able to support all the companies to grow to the next level. From the investor side, I think that's also another interesting part. I think, yes, I think Asia, people are really excited about the growth. VC has provided a lot of great companies in the past many years. And now technology, AI, big trend. But that does not stop in just equity, right? That's how we think about there are LPs coming in to say, hey, I want to also capture this growth in Asia, but is there a safer instrument to be able to do that? For the credit strategy we launch, we do not look at venture debt. It's not a venture debt strategy. What we do is we still look at where our credit investors had. We find these traditional business that are looking to use technology to transform themselves. It doesn't matter what industry they're in. Manufacturing, can be healthcare, it can be across the region. Everyone is asking, how do I use technology to make operation more efficient? And how do I use it to do, technology can help with the customer acquisition now a lot wider and faster. So that for the traditional mature business, they may not want dilutive capital. So non-dilutive capital, but still with that expertise and help and network that large size equity or the VC players can offer, then that become a very interesting way to invest and capture attractive risk return for the investor as well. So that's how we look at the whole different asset class.
Yeah, yeah. Thanks. I want to step back just a little bit, Conrad, as I move on to you. So there's a lot of like we see something is broken in the VC market, and obviously that's more evident in Southeast Asia rather than in China. And you're active in both markets. What can you tell us?
I think I would say two things. First of all, is that we are being based in Hong Kong here, being a global financial center. We see a lot of talents here have the ambition from Greater Bay Area to expand to Southeast Asia. Similar time zone, proximity, similar culture. So some of our portfolio companies, in fact, actually from here, and then they expand to Southeast Asia and the Middle East. And actually, governments have a lot of supportive measures. Speaking of which, Hong Kong entrepreneurs are like that. I think Malaysia and also Singapore, they have a lot of supportive measures for the startups to go across the region, if not in other parts of the world. I think that's the first one. And the second one, to answer your question, is about Southeast Asia. I think there's a lot of concerns, I would say, about the investment and development in general. And as shown as some of the charts that Joji put up this morning, the amount invested, the proportion is like so small as a percentage of total Asia and all that. I would say the following, a few things. First of all, we are a fundamental driven investor. And I cite a few figures and that can help you basically have a better understanding as to what we are talking about here. So in 2025, the whole ASEAN country, the foreign direct investment, FDI, amounted to $225 billion US. And the growth rate varies middle to high single digit. That's for a full year. And when I look at some Q1 2026 figures, I was stunned actually to see some of the numbers. First of all, for Vietnam, if you look at those numbers, the Q1 FDI year-on-year growth, 42%. For the audience, you have people from Vietnam. For Philippines, the Q1 2026 year-on-year FDI grew 53%, 53. So money is not dumb, money is smart. Why would they pour so much money into these destinations? Must be some fundamentals that appeal to them. In the case of Malaysia, for example, in 2025 last year, manufacturing investment, including domestic and from abroad, amounted to $32 billion US. It's a significant amount of money. So a lot of people are saying Southeast Asia not investable and scandals, corporate governance, all that. Yeah, sure. But at the same time, there are like millions of companies in Southeast Asia. You have 5 or 10 companies having corporate governance issues. So what? You still have the millions of others that are still operating with strong fundamentals and all that. And I'm quite glad we're just looking through our own portfolio companies. They're all doing okay across Southeast Asia. And that's why I think my argument for people who have like reservation about Southeast Asia is that should take a longer term view. If you recall, as recent as maybe 3-4 years ago, conferences like these, there were people saying that China was not investable, right? You remember that, right? And look at what happens now.
When was this?
3-4 years ago, not that long ago.
Even last year.
Right? And now everybody wants to invest in China. So I think, and that's why I take a step back. Same thing for Southeast Asia. Again, we are fundamental driven. We're not momentum driven. We're not hedge fund. We believe the fundamentals will drive investment opportunities. Right now, it's going through a cyclical pendulum, but pendulum always swings not in just one direction, right? So arguably, I know it may not be easy to convince people here in the audience, but I think it's not a bad idea to invest in the Southeast Asia right now because market is quite cold. You can take your time to do a lot of diligence, talk, negotiate. Founders are humble, easy to work with. Whereas some other markets, I don't name names, some other markets, you won't get into VC deals, or you have to pull the string from this founder, from that VC. I want to get allocation of a percentage. Oh, by the way, sorry, we can only get 1/3 of what you're asking for allocation, fight for allocation. So it's the two sides of a story. So that's what I'm saying. If you ask me, it's probably easier time to invest in Southeast Asia than some other parts of the region. I'm not saying that you're going to make a lot of money from Southeast Asia, but what I'm trying to say is that investing in Southeast Asia at this point, the downside is probably limited based on my 30-year experience in this industry.
Great. Thanks, Conrad, for that thorough explanation. But of course, what you're referring to is really on the manufacturing side. The themes that are influenced by U.S. decoupling from China, I would say. But when you look into VC, not so much. I mean, we're in a different.
No, it's the
position
contrary.
for sure.
Contrary. The reason I'm saying that is that just take a few examples. Because of these technology restrictions from US, you see a lot of Chinese companies in the semiconductor, the deep tech space. They go into Malaysia, for example, to set up fabless design, to set up a testing assembly, and then you see in the minerals, there's a lot of Chinese companies going down to Indonesia, for example, in extraction, in refinery technologies as well. So it's not necessarily just a heavy industry. It's a lot of like an asset light, in particular the fab design. A lot of companies have gone to Malaysia, and a lot of them continue to do so. And that's why I'm talking about the corridor between the, China, Asia, and then the Gulf that you just had the panel just next door, right? That's going to continue. It's all part of the Belt and Road initiatives.
Thanks, Conrad. Piyush, moving on to you. So you set up your fund in 2024, correct? Assuming that you already see the opportunity lining up for you in terms of secondaries for late stage, growth stage companies, right? But at the same time, we just saw some data earlier today from Evercore in terms of secondaries. Asia Pacific is like what 3% of the total pool. So where are we in terms of There's been a lot of talks about secondaries. But what are you seeing?
So secondaries is a derived asset class. Okay, it's a derivative of the primary markets, and the larger, deeper, and longer the primary markets have existed, that creates the conditions for a significant secondaries market. So if you look at Asia Pac in general, and then maybe India, Southeast Asia specifically, these are the youngest primary markets, relatively speaking. So US is much larger, but also has been around for much longer. So, and in US, like if you look at a secondary firm like Industry Ventures, they've been doing that strategy for close to 20 years. Okay, this is just getting started in Asia Pacific. So I would say two things. Firstly, now you have, when we look at investing in companies, these companies have typically been founded prior to 2017, because 10 years is nothing in early stage. Like that's when you have a company of scale that you start thinking about exiting from your fund. So it's a smaller market to work off. But then if I look at the growth rate of primary, which is the end market for us, that's been growing at like 25% a year since 2017 to 2026. So I think this is just a natural state of play. You're going to get a very large secondary market. Now within secondaries, people have different strategies. But the thing about direct secondaries is one has to be from the ecosystem, because before you can deploy any intelligence or agentic AI on the data that you get, you have to get the company to agree to send you the data, right?
Yeah.
And that comes with relationships and access and founder comfort that they have good shareholders coming on the cap table to replace whoever they have a relationship with in the past.
Okay, cool. A lot of, at least what we have been reporting, is GP-led transactions, right? Is this a good indicator? We're seeing it as sort of like, yeah, I mean, not a shortcut, but a way to liquidity. What are your thoughts on that?
Yeah, so I think, look, GP led is a very interesting phenomena, but it's a very specific product. Okay, so the all the flagship GP leds that have happened that I'm aware of have happened in the really strong assets with really strong GPs, and that too with, I would say, much more of a buyout GP mindset, because it makes sense for a GP who's been managing an asset well to continue managing the asset on behalf of new LPs. We find that minority investors with non-operating uh, capabilities in a company, for them to do a continuity fund or a GP-led, as you call it, is less relevant. So I feel like the GP-led is a very specific product for a very specific situation. Otherwise, it's just probably better for that investor, the GP, to sell the asset clean, send the money back to LPs, and focus their time on the next set of things that they're working on.
Okay.
So, but again, I think in life, nothing is always 100% black or white. It's always going to be, okay, a bit of this, IPOs, M&As, direct secondary, all four products will coexist from an exit perspective for GPs.
Jerry, how do you see secondaries in your strategy? And can you paint a broader picture in China? What's going on in terms of secondary transactions?
Well, first of all, I think at INS Capital, because we were founded in 2019, and we operate two venture funds and one follow-on fund that has a 2023 vintage. First of all, I think because we have some great IPOs that are returning multiple times our funds, I don't think we're going to consider secondaries in those major assets, right? Because you have to keep your home runs, right? So you can get the big DPI out for your LPs. But if I step away from my GP shoes and maybe comment it from an LP perspective, because I was an LP with Common Fund since 2011 to 2018. Yeah, I mean, for a long time, everybody has been talking about China secondaries, right? I just don't think it's as popular as in the US, right? I don't think the secondary market really has been growing or as big as we are. And this kind of comes back a bit to your point about, kind of VC models and also what could be broken a bit in the system. Sometimes with secondary players, there's this inherent, we need a certain discount, or we can't talk about anything until there's like a 70% discount in China assets, which I think was the going rate a few years ago. And maybe 40% is like a best. But when I was at Common Fund, we actually had the chance to work with one of my then secondary heads, and we actually back then had bought secondaries at a premium and still made really good returns. So I think there can be more secondary transactions, I think, in this part of the world. Of course, it depends on who's interested and the lot of different asset class you can choose from. But I do think it could be over time a healthy way for GPs to consider as an exit method. This me commenting from my LP shoes.
Okay. I'm going to pause a bit to allow at least one question from the audience. I should just remind everyone, you can scan the barcode and send us the question. So I'm going to take this one regarding first-time fund managers, basically. So debut vehicles by first-time managers are bearing the brunt of the fundraising downturn. How will this realignment in favor of established managers to reshape the VC ecosystem? Any takers? Yeah, the second question right there.
Well, first of all, it depends on the first-time managers what they're investing into. So a lot of our peers that we are seeing in certain parts of the world, China, US, and whatnot, if they invest in deep tech, their background, they are PhDs, they could be university professors, and they're really good in AI, quantum computing, and whatnot. So those are very talented people. They know what they're doing, what they're investing into, but they don't have the brand of established fund manager. On the other hand, you have a lot of very outstanding managers who even some of them started in 1970s and get to where they are today. Big brand and lot of successful track record. But do the top people in these established fund managers really know these latest technologies? So I guess the choice for an LP, because we look at some LP stuff as well. So as an LP is to whether they want to back an established manager, that relationship with them for like a decade or two, but you're asking them to look into something that the team have little experience with, AI, whatnot, quantum, semicon, whatever, versus a bunch of people who are really bright, knowing what they're doing, but they don't have the brand that it carries. So and I think that's where it's a question for the LP itself. Some people probably would be happy to back the emerging managers, in particular some of the family offices, like our fellow family offices. But it may not be easy for some established institutional LPs to back these managers.
Maybe you want to share your experience. I mean, you're not a first-time fund manager, but still, when you started.
No, Kenro is a first-time fund, so I'm a
Yeah.
first-time manager, and I would say it's certainly the hardest thing that I've done because you have to raise capital simultaneous with recruiting the team, with finding the right deal flow, executing that, while you're also building out your fund platform infrastructure. So, but I think the question is not that. The question is the market, the capital is consolidating with established GPs in the VC market. I think yes and no. Actually, at least I don't know about China, but at least in India, we see tremendous amount of new GP formation, and they all are getting more niche. So what used to be general platforms doing seed stage, growth stage, multiple sectors, the first evolution towards more specialized strategies and more specialized sectors is happening right now. So even in the US, I think what Conrad's referring to is that you have people who are specialized in a very particular niche, maybe the deep tech, and they still have a role to play.
Yeah.
But it's hard to recreate a generalist fund manager because that's not where the market is anymore.
Yeah. I assume this is more widespread in China, Jara, in terms of very specialized players for first-time fund managers.
I really think it depends. I really think it depends on the track record and the time and space when they're raised and if they sort of fall under something that the LPs want.
But in terms of sectors that you're seeing where the first-time managers are focusing, I mean, obviously this AI and
Well, I think nowadays, if you're doing China venture and you don't talk about AI, you're not going to get very far with the investors, right? Everyone is somewhat doing AI. So I do think, yes, for a lot of LPs, they want certain kind of sector specialization when they look at managers. And so for Asia, for China right now, the big opportunity is AI, the whole AI value chain, right? Of course, with that, you relate then to semiconductors, to hard tech, to embodied robotics, and then biotech as well. Of course, for us, we started biotech a few years ago, and that's been really fruitful for us because China biotech out licensing has just become like phenomenon in the whole world. So I do think that, yes, to your point, sometimes sector specialization helps.
thank you, thank you. Going back to our topic on in terms of multi-asset funds. What I see here, Granite at least, I mean, seems to be doing more than adding private credit product. Obviously, this DBS partnership and AI IPO fund. Like how should we understand like Granite's strategy these days? What are the problems that you're trying to tackle?
Sure. I think as you mentioned on the IPO fund, so we had we launched a private IPO fund with DBS last year, pretty much focusing on the opportunities coming up, the IPO opportunity, pre-IPO opportunities on the AI and tech space, and that was attracted a lot of interest. Where we're seeing, as I shared earlier, that one, demand is important. and also demand from investor. We're hearing what the investor would like to look at, as well as where do we see that the value that we can bring into that. So if you look across Granite Asia's platform, we are leveraging on the strong, for example, just take Libra Hybrid, the credit fund as example. Sourcing, we are private equity style sourcing, where we go across and then going different sectors, vertical, go across the whole vertical to look at potential deals. And with the advantage of being in Asia for over 26 years, I think the inner circle proprietary deal flow that really helps to get us that origination, solving all the origination questions that people do have on the private credit side. The same time, we wear our private credit hats. We have a full-fledged team that we have been looking at downside for many, many years. So we still look at the underwriting, how to underwrite the risk, covenants, collateral cover. And on top of it, our value creation team come in to actually do their magic of creating. We have created over 100 unicorn and 60 IPOs over the 26 years, right? The same magic that how do we actually work with founders from 0 to 1, 1 to 100, and now we use the same capability, that programmatized ability to help these company, even it's a credit investment, we still help them to grow to the next phase. So I think it is coming back to in terms of what we're looking at. We just think the growth in Asia, Southeast Asia, it's across China, cross border. It just there's so much opportunity that can be captured through different elements and different capabilities.
Cool. Conrad, I mean, among the panelists, you have sort of like a broader toolkit. You invest across growth stage and basically venture PE style opportunities. Which ones are doing? Which ones are working for you now, and how do you see that in the next 5 years?
A lot of things work. I think on the early stage, we see the emergence, which was not there a few years earlier. It was a lot of university-backed startups. I think not just Hong Kong itself, but I think a lot of university that we are seeing, they're actually increasing the effort in the incubation programs, the in-house funds to back the alumni or the faculty members to use their IP to commercialize it. It's definitely very happening here in Hong Kong. I understanding in Singapore, in Malaysia, and then other parts of Asia, Korea, Japan, for example, also very popular. So won't be surprised to give, to your point, 3-5 years view, you will see a lot of companies, they are from university, from research institutions, eventually being commercialized companies and then become public companies. And then the original seed university investors or some other VCs that come in will benefit a lot. I think that's one trend we're clearly seeing. And then the second one that we're seeing is that, again, back to my earlier points, the cross-border opportunities. Even though some of the generic single market in Asia are quite big, right? China, Indonesia, Vietnam, or Japan. When they jive, a lot of companies, a lot of the entrepreneurs, their ambition to go out to other places to basically do business in each other places. And a lot of, I would say, capital markets are geared for that. Hong Kong Stock Exchange, Singapore Stock Exchange, Tokyo Stock Exchange, just to name a few. They really encourage people who are from one place, but they expand to other parts of the region. So I think we see more and more cross-border regional opportunities coming up wherever they are from. And we have quite a number of portfolio companies actually in that category, and we're just seeing more and more opportunities like that.
How about sectors? Any sectors you'd focus in the next 5 years?
We have a bit of like an impact angle. So we invest in climate, healthcare, education. AI to us is basically is horizontal. So AI is important. Everybody will use it. So you take a longer term, 50 to 100 year view. AI will be like electricity today, or like internet today that everybody uses.
Pius, so for investors wanting to invest in pre-IPO firms, what are the sectors that you're looking at the moment?
So we are sector agnostic, okay? But when I say sector agnostic, because our first 3 investments, each of them are in 3 different sectors. Our first company was an education services business. It's the single largest operator of private schools in India. The second one was a fintech, It's called Pine Labs, and they're a large company in that space. And the third one is a consumer company which retails silver jewelry, modern silver jewelry for the younger uh, cohort of buyers. So I would say that we think about diversification a lot, okay, because some sectors in our markets are regulated, and therefore we have to spread a risk out. There are different macroeconomic factors that also come into play in emerging markets. And that's why actually, Kendro Capital, Kendro, the word means strength and resilience. Because we're like, anybody investing in emerging markets, like better be ready for the ride.
Okay, so in terms of macro risk that you're, like your top concern, like is it current exchange, foreign currency or inflation or what?
Actually, it's a foreign exchange, but also it's about the impact of high oil prices and inflation on macroeconomic conditions. Because, like, let's say we're evaluating a financial services business, both the dispersal rate and the repayment rate from the borrowers both get impacted by that. Our consumer business imports silver jewelry, silver as a base metal for as a raw material. That gets impacted by foreign exchange.
Yeah.
So there are many first and second and third level impacts that go into these businesses. So yeah, and there's so many ways in which things can go wrong that's what keeps us up.
I mean, which market you're most concerned about when it comes to macro risk?
I think, if you just put the two buckets on developed Asia, like how investor would like to classify emerging Asia, I would agree with Piyush's side. I think to be able to invest across Asia, you just have to look at every single countries and what are the typical the risks across it. But I think coming back now, I think what I would think the investors will have to be, very, very aware. And what we are discussing and thinking every day, of course, is geopolitical uh, overall that, on the overall Asia and how would that impact. It wouldn't just be risks, it's also opportunities, right? Like when we discuss about how the companies are moving their supply chain, reallocating the either their factories or companies or tech to just diversify on where they will be and just to mitigate the overall geopolitical situation, that actually creates a lot of opportunity for investors, like across the different asset class. So I think it's the risk, where Asia always have, you mentioned currency, inflation, political, domestic political, like all that is important, and as well as how do we actually try to capture the right opportunities at the right time. Right.
You're saying Indonesia is a big concern.
I didn't say that, Andy. We're very active in Indonesia as well. So
Jerry, how about in China? I mean, what are your portfolio companies? I mean, when you talk to the founders, so what are their main concern with what's going on in terms of geopolitics and
So first of all, we're a venture capitalist, and I think we sort of have to be a little bit more optimistic when we think about investing. If you wake up every day thinking about risk, I wouldn't be in this business. I want to talk about something else. So we talked about global, we talked about the VC model, and there's something I'd like to share that, and also I looked at some of the questions about kind of US-China VC, what's the difference? So first of all, a quick comment on kind of this global idea, right? Because it's not the first time that we hear China innovation for global value capture. Early in the years, we heard Chuhai, right? For us at INS, it's actually not a simple matter about kind of China exporting products abroad. It's because we can actually build businesses that are global inherently from day one. And we see this across our AI-enabled portfolio. We see this especially in biotech, because a lot of the China drug discovery right now works with global pharmaceuticals, and that's going to literally, I think, change the world. But if you kind of take a step back to give you an example, right? One of our companies, I won't name the name, but Chinese heritage founder, they've worked with Huawei and Alibaba for many years, and they've built a last mile delivery logistics tech company. When we met them, right, 5 years ago, fast forward to today, the revenues have grown 17 times. The number one in the Middle East, the number one in Mexico, Brazil. They work in Europe and Australia. They're in 30 different countries. They take everything you know about China logistics, right? All the lessons that we have, you apply it in different parts of the world. You do last mile delivery for e-commerce firms like Shein and TikTok and Temu, right? This is for sure global business that is backed off of tech infrastructure, but operated locally, but also I think a wonderful example of China innovation, right? You go to the other spectrum, you look at one of our, for instance, our AI biotech companies. And they're working right now with Sanofi, which is French, creating these multi-billion-dollar pipelines, and they're big in immunology and oncology, and of course, they hopefully some of what they develop could be impactful for a lot of patients. I think when we think about the idea of investments today in China, it's no longer just about kind of we have to invest in a certain region, or we think about GDP. You're really thinking about innovation at the core. You think about what these Chinese founders can bring and whether these businesses fit for the global market. That comes back to our underwriting, because not every single entrepreneur or every business can build a global business. So I think on that end, there is tremendous opportunity set, because I mean, look, if you've beat out like Alibaba and ByteDance and Tencent, you've been trained by like this super competitive, fertile ground in China. I think you stand a chance kind of running a global business. And that's where we see that AI talent and that biotech talent really creating global businesses.
Thanks so much, Jerry. We're running out of time, but I have one closing round. So here's my question: like, when you look at 2030, what will be the most different with Asian VC in your view? Is it the LP base? Is it the fund structure? Is it the exit pathways? Pierce, you can take that question. You can start.
I don't know exactly how it'll be, but I can tell you what I wish it to be is, what we do in the private side is all a flywheel. Okay. Capital, company creation, value creation, exits. That's the flywheel. When any part of this flywheel gets broken, whether it's exits, whether it's lack of company formation, whether it's lack of LP capital into GPs, or the GP value creation, there is disappointment. What's worked very well in the US is that the way the system has worked is that every element of those four flywheels has been supported, and that's what I would love to see in our part of the world. But I think we deserve it. I think we have amazing founders and entrepreneurs. We have great GPs. We don't have every part. I mean, the friction is high in many parts of the system. But yeah, that's what I wanted to be in 2030.
Cool. Conrad, what do you see 2030?
Well, I think in Asia, certain parts of Asia, I think a lot of LPs are concerned with DPIs. So we hope that with industry practitioners like ourselves lobbying governments to make the stock exchanges more startup friendly or tech company friendly. So
Fun friendly.
we are fund friendly as well. For some of them, you can directly list their funds on the exchanges. So I think that's one thing that at least solves the question of a lot of VC exit, mainly depend on IPOs. On the trade sale, of course, a lot of people are willing to pay market price rather than try to lowball people so that everybody gets stuck in a secondary and all that. So I think the exit incentives and the more focus on exit then would make the whole thing more complete. Many parts are already working in certain parts of the world to a certain extent, but I concur with Piyush. You need the whole thing, all four elements to be in place to make a complete ecosystem.
Thanks, Conrad. Okay.
I'll just probably complement this with what we see on the LP space. I do think by 2030, there will be a shift. We historically see a lot of US, European institutions investing in VCs in Asia, but I think now Asia investor who used to just invest in US and Europe, they are coming back. That's what we are seeing. High net worth, family offices, they are a driver of the new trends as well. They can make decision. They understand they don't need different consultants to give them the answer. They actually make the independent decisions to look at the strategy, what makes sense, what not. So I do think the LP base are also shifting, and Asia risk is appealing to become very appealing for very different investors nowadays.
You also mentioned earlier when we had a talk that almost all your LP for the private credit are Asia, right?
Yeah, so currently, I mean, this is our first attempt to raise the private credit fund, and very fortunate we have Asia-based investor institutions and across that supported the strategy. And I was just sharing, Andy, I haven't had time to visit Europe and US, and we're actually closing the funds at the target already. So I think that's where we do think the Asia investors are being more active in Asia now. Yeah.
Jere, last one for
Okay.
2030.
For 2030, okay, so let me answer this in two perspectives. I think one for the industry, I hope that in the next 4 years, right, that we really focus on innovation and the performance at the core, that maybe we can do away with some of the labels, kind of, are you a generalist fund, are you established fund, or emerging fund, and just focus on whether this manager can build a portfolio and generate venture returns. Well, in my case, venture returns for the LP. So I hope that there could be more kind of going back to the fundamentals, understanding cycle awareness, and giving credit to VCs or GPs that can build businesses that actually have long-term value creation and can create exits. And then for ourselves as GPs, I hope that by 2030 we can continue our track record. My team, since 2006, every one of our funds have been profitable. So I hope that in the next 4 years, in 2030, I can still say that every single one of our funds are profitable and that we made great returns for our LPs.
Okay, good luck with that. Thank you, everyone. That's all we have for this session. Thank you so much. Thank you, panelists.